everyone. My name is Sasha Padbidri, and I'm deputy editor with LevFin. Welcome to another episode of Cloud9Fin's Syndication Nation podcast, where we unpack all things leverage finance. Today's episode, we'll be diving into the Halo trade with LevFin reporter David Westenhaver. Welcome, David.
Happy to be here. Thanks, Sasha.
Awesome. Let's get straight into it. So everyone's been talking about the Halo trade, especially in the equity world, but in the debt world, things are a little different. So David, just for our listeners, we keep hearing the word Halo everywhere, but what does it actually mean and why has it taken it off now?
So Halo is an acronym that stands for Heavy Assets, Low Obsolescence. And the point of this trend is essentially to invest in companies that might be protected from AI disruption. It was recently coined by an investor who highlighted names like Walmart and McDonald's and ExxonMobil as examples in the equities market, as they've all been outperforming the market this year. But it's something that we're seeing in leveraged finance as well, to a certain degree. But essentially, we've seen software disruption to start 2026, and these names are essentially those that aren't going to be disrupted by AI in the same way.
Great. So it's essentially the anti-AI trade.
Yeah, it's sort of seen as a safe haven to AI disruption.
Yeah, perfect. Okay, so one thing that stood out in your reporting is that, this isn't necessarily about conviction. It's also about capital needing a new home, if I'm not mistaken. So can you just unpack all of that, please?
Yeah, so like I said, the software disruption has been obvious in leveraged finance. That's probably been the major story of the year, at least up until the war in Iran. And that capital needs a place to go. And so this has a lot to do with just finding a new home for that capital, more so than deep conviction in these broader Halo industries. Because, Halo, it's somewhat of a vague term. For some investors, they see it simply as industrials. Others would say names like McDonald's that you might not think of as
blue-collar trades, right?
Blue-collar trade, exactly.
Yeah.
Manufacturing and those kinds of companies. But the benefits haven't really been even throughout those different spaces.
So if they haven't been that even, what does that say about the Halo trade in terms of benefiting any LevFin credits? Or would you just say this is an equity story?
It's definitely not just an equity story. It's something that's already playing out in leveraged finance. But again, it's not as evenly as the name suggests. We spoke with a banker at Barclays who pointed to a deal that they did in Europe earlier this year for a company called Ramuden, which essentially supplies concrete blocks and traffic cones for roadside construction. It's a very simple business. And, the deal did well. It priced tighter than the debt was trading prior to the deal. But there was some suggestion that had that deal come to market late last year, it might not have been received as well. That was a time where, in some ways, AI was
still hot.
It was hot, and a lot of those software companies were benefiting from the AI trade. And then obviously that narrative has flipped this year. So now people want to, in some ways, they want to insulate themselves from AI. We'll get into that in a minute, I'm sure. But it's essentially, looking to get into these companies that are protected from that, and it already has begun to play out in recent months.
Great. So what about the trade is actually working, and what kinds of credits are seeing real demand?
So there's really two buckets of credits that are benefiting here. One are those that are essentially the pick and shovel plays for AI, energy providers, those that are tied to data center construction. And then the others are examples like Ramuden, where it's essentially an industrial or manufacturing name that is just essential to the global economy. Another source we spoke to mentioned waste management names, right? You're going to need waste management companies regardless of whether AI blows up or peters out in the next few years and doesn't disrupt as many industries as people might fear. So those are the two buckets that are really benefiting from the rotation. It's companies that really fall into that low obsolescence bucket, or those that are really benefiting from the increased investment into AI infrastructure.
Got it. And what about those that haven't quite, benefited from this trend?
Yeah. So in some ways, this list is longer than the list of industries that have benefited. So, an obvious example would be chemicals. There's been trouble in that space since the end of 2025. Building materials has been another one. Sources said outside of data center production, we're not exactly in a great period for construction. And so a lot of building materials companies, they're not seeing the same benefit. And manufacturing names as well. We mentioned some manufacturing names that are doing well, but it's not lifting up the whole sector like some might suggest it has.
Got it. So based on the conversations you've had with other sources, can we consider these asset-heavy businesses a safe haven?
So I would say they're a relative safe haven compared to software names that are clearly ripe for disruption from AI. But in general, no, they're not a safe haven. There are a lot of risks here, and most of them are macro related. The kind of risks that no company can escape if things turn the wrong way. Much of this has to do with rising input costs, the rising cost of energy. That's already led some CEOs to delay CapEx spending on big projects, which of course filters down to manufacturing names. But they're also seeing that on the consumer level, or at least they're preparing for disruption on the consumer level. In that, if prices rise in energy, then that has a downstream effect, and consumers might cut back on spending. And we don't necessarily think of manufacturing as being super exposed to consumer sentiment, but many of those names are. Sealed Air was an interesting example. Without getting into the deeper details of that deal, that company has exposure to consumer packaging, and so consumer demand has an impact there as well. And so that's something that's going to filter out across a lot of those names.
Got it. Just one last question. Do you see any cracks derailing this movement, if at all?
The energy risks are the big ones. Inflation, again, cutbacks in consumer or corporate spending. I would say those are the key risks there. Obviously, we don't know what's going to happen throughout the rest of the year, particularly with Iran. So it could go either way. It does, again, seem to be like a relative safe haven to a lot of these software names that investors just can't increase their exposure to. But some of those names that don't fall into those two buckets, the AI picks and shovels play or the essential industrial services play, those credits could be at greater risk.
Got it. Well, David, thank you so much for unpacking this with me. If you like to check out this story on the 9fin platform, please email us at podcast@9fin.com. Thank you, listeners, for tuning into this episode of Syndication Nation. We hope to see you next time.